If you're a foreign national selling property in the United States, there's a U.S. tax law you need to know about, and most sellers aren't warned about it until it's too late. It's called FIRPTA, short for the Foreign Investment in Real Property Tax Act. And if you don't plan for it properly, it can take 15% of your sale price right off the top at closing, even if you made no profit on your sale. Here's what most people don't realize. This withholding isn't based on your profit. It's based on your gross sale price. So if you sell your property for $500,000, the IRS can hold back $75,000 immediately. That money isn't lost. It's treated as a prepayment toward possible capital gains tax. But you won't get it back until you file a U.S. tax return for the year of the sale, which usually means waiting until the following year to receive your refund. With the right plan, you can often reduce or even eliminate that withholding legally. I'm Johanne Sabia with the Sabia Team here in South Florida. My wife Joanne and I are real estate agents who specialize in helping Canadian and other foreign owners sell their U.S. properties. And we've guided many clients through the FIRPTA process from start to finish. Joanne is originally from Quebec, Canada, and she's fluent in both French and English, which makes communication seamless when we're helping Canadian and international sellers navigate the U.S. paperwork, the tax rules, and closing procedures. We understand exactly how stressful it can feel when you're selling from another country, and our goal is to make sure you're protected, informed, and confident before you ever list. FIRPTA applies anytime a non-U.S. resident sells real estate in the United States. At closing, the buyer, through the closing agent, must withhold part of the sale price and send it to the IRS. In Florida, who selects the closing agent can vary depending on the county. Sometimes it's chosen by the buyer, sometimes by the seller. So check with your real estate agent to confirm how it's handled where your property is located. There are 3 price tiers under FIRPTA. First, if you sell for $300,000 or less, and your buyer or a member of their immediate family intends to use the property as a residence, meaning they'll occupy it for at least 50% of the days the property is used by anyone during each of the first 2 years after closing, will not rent it during that time, and will sign the FIRPTA affidavit confirming that intent. There's no withholding at all. Second, for a sale price over $300,000 and up to $1 million, if the buyer meets that same occupancy, non-rental, and affidavit requirement, the withholding drops to 10% instead of 15%. And third, for any sale over $1 million, withholding is automatically 15%, no exceptions. So if you're selling at $990,000 and your buyer plans to move in, you qualify for 10%. But if you sell over $1 million, the full 15% applies. That's why smart pricing and early planning really matter. Here's what happens behind the scenes. The buyer or title company files IRS Forms 8288 and 8288A, along with the withheld funds. As the seller, you'll need a U.S. tax ID, either a Social Security number or an ITIN, an individual taxpayer identification number. If you don't have one, apply for one before you list your property for sale. Waiting until the last minute can delay your refund. You can also apply for a withholding certificate. That's Form 8288B, which may reduce or even remove the withholding. But that application must be filed before closing, and it can take several weeks to process. If you're a foreign national selling property in Florida, here's how to stay ahead of FIRPTA. 1. Know which price tier your property falls under. 2. Coordinate early with your buyer to get that occupancy affidavit signed. 3. Get your Social Security or ITIN number before you go under contract. 4. Work only with real estate agents like us, closing agents, and accountants who handle FIRPTA every week. 5. Apply for a withholding certificate if you expect little or no gain. Joanne and I partner with accountants and Florida closing agents who specialize in FIRPTA. They know how to prepare the documents, communicate with the buyer's side, and prevent unnecessary IRS holdbacks. FIRPTA also affects your taxes in Canada or your country of residence. You'll file a U.S. return to reconcile what was withheld, and you'll report any gain to your home government. Even exchange rates between the US dollar and your local currency can impact your final numbers. That's why it's so important to plan this from the start, not at the closing table. We've created a simple FIRPTA seller's checklist that walks you through every step, what forms you'll need, how the exemptions work, and how to prepare before listing your property. If you'd like a copy, just comment checklist below or email us at the address in the description to request it, and we'll send it right to your inbox. You only sell this property once. Make sure it goes smoothly and that you keep as much of your proceeds as possible. FIRPTA is real, it's enforceable, and it's completely manageable with the right plan. Thanks for watching, and if you found this helpful, please like, subscribe, and share it with other Canadian or international property owners who might need this information.